Good morning, everybody. Welcome to another Daily Market Bar brought to you by Mike Bjork. Today is Friday, April 13th. Yes, it is Friday the 13th. I hope you guys stay lucky and have a great upcoming weekend here. Let's kind of jump right into this right now. We have a couple economic news releases to go over today. We got the consumer sentiment, which has a relatively high impact, but not really high. Because obviously, if consumers are doing well, they're going to be spending money, which is why it's kind of somewhat of a high impact. So March we had a 101.4 on the index level here, which is very high, and it was supposed to stay in that same range at 101 forecast for April, and it dipped down to 97.8. So still a very good number, but obviously it dipped, so therefore it's not as high as before. Job openings for the month of February, we see it shrunk a little bit. So in January, we had 6.2 million job openings, and it dipped by 100,000 to 6.1. So far, the stock market is down. It actually started up higher. We had some great 2018 Q1 earnings reports, which is kind of taking more of the headline news today. The other stuff is the geopolitical stuff is kind of taking more of a back seat as nothing really new escalated so far. But the Q1 earnings reports came in, and today we had three of the major banks came in and gave the reports. Now, a lot of these are coming in really good numbers here, very strong numbers here. But Wall Street, these investors have very even too high expectations, and because of that, even though they started the morning up higher, they dipped down. They did a complete 180 and now are trading in negative territory, even though the stock market was doing well. And these are some of the strongest reports we've seen in probably nearly a decade right now. So it's kind of unfortunate that they're having such a too high of expectations, and it's more emotion based right now, where the stock market is, why it's pulled back a little bit. Here's the bond market. So as a result, the bond market is kind of rebounding a little bit as a result of this little temper tantrum, I guess you could kind of say. As we saw, we had a pretty big day yesterday. It dropped quite a bit here. We had a price for the worse yesterday. It changed. As we mentioned, this is going to get squeezed at some point or another, and I did forewarn that it would go. It would basically most likely squeeze to the to the lower side of things, because that's going to be the trend where rates going to be going down. We just got too many variables to play into why there's not enough demand for bonds to let it boot to give it that extra boost. There's just not enough demand for it. So if anything, it's going to lead towards going towards the bottom, which would raise interest rates. So today, right now, we're up about 8 basis points so far. As you see, we've kind of touched up a little bit few times here this morning so far, but right now we're currently about 8 basis points from where we left off yesterday here. Not quite enough to have a price change for the better or anything, but pretty close to where we left off yesterday. Now, people who didn't do the price change for the worse yesterday will have probably worse pricing than what they had yesterday. So here's the yields here. We did break above the 25-day moving average, but couldn't break above this 50-day moving average. Today it did test that 50-day moving average, and right now we're just sitting just at the top of the 25-day moving average in this little range here. And we're down to about 2.82 right now. So we were up at 2.83, and then now we're down to about 2.82 range right here. All right, so if this gets a boost above here, this gives us more ample room to push bonds even further down. So this is why this is kind of important. If these can hold to keep yields lower, this will help with interest rates. But on the other flip side of things, again, when the Fed raises rates, the 2-year Treasury is going to be going up. With the 2-year Treasury going up, that's cutting the spread between the 10-year and the 2-year. So that gives us basically inverted curve. So if we get an inverted curve or a flat line curve, basically what that means is it could push us into a recessionary levels here. So again, that basically what that means is that the short term is now greater than the long term in interest rates here. So to wrap things up, again, rates are about the same as where we left off. If they did not do a price change for the worse yesterday, they have done it today. They put in today's pricing, so some people may have worse pricing today as a result. But if you guys want to get more data during the day, just come over to Twitter. I do post on Twitter if you want to get your throughout the day updates, more up-to-date updates. Just go over to Twitter. You can follow me at Mike Bjork. Otherwise, I hope you guys have a great weekend here, and I look forward to see you guys on Monday. Next week we'll have more housing data coming out. So NAHB will come out with the report. We'll see new home sales, stuff like that. So, uh, anyways, just you guys have a great weekend. I look forward to see you guys on Monday. Thanks for watching. Bye bye.